The Vancouver real estate market is red hot once again. If you go to an open house, you're going to stand in a line. If you go to offer, you're likely in a bidding war, and we are already seeing record prices above what we saw back in 2021 and 2022. And yet, there's way less homes to choose from. And also, what's changed? I mean, we're still in an environment where interest rates are as high as when they caused prices to drop. And yet, here they are ripping upwards again. And the other question we get a lot is who's buying? Who's buying? The prices are nearing all-time highs again, and yet interest rates are also way off of where they were 2 years ago. So who is buying? And we're going to get into that question and give you some of our thoughts as well. With prices going up, of course, this makes things harder for the Bank of Canada, who also think that now, even though inflation dropped almost a full point last month, that things might get a little sticky trying to get it below 3% target. So we're going to talk about that as well. And then get into four major key metrics that clearly paint a picture as to where we can expect prices to go next, including some mind-blowing population data for the first 2 months of 2023. So clearly, things are changing quickly. And if you're considering buying or selling, well, the strategy today is dramatically different than what it would have been 3 months ago. So if that's on your mind, feel free to reach out to us at any of the contact info below, and we'll talk about what's best for your specific scenario. Great. So let's dive into today's episode. Ryan, why don't you kick us off here talking about what's happening with inflation?
Yeah, the Bank of Canada released its monetary report Wednesday of this week. And before I kind of get into it, I really want to talk about maybe two particular scenarios. One in which the Bank of Canada is clearly messaging, and then the other one is from macro economists who are looking at the messaging, looking at the economy, and maybe feeling like the Bank of Canada is putting a strong message out there and warning people, as opposed to necessarily actually going to go through with what they're talking about. So the major sort of piece that came out of the monetary report is that, a lot of economists and future markets were pricing in rate cuts either sometime in the third quarter, maybe even the fourth quarter. And the Bank of Canada really came out to kind of squash that. And there's a couple rationales. So I'm just going to quote some of the article here because it's important. One rationale is that markets continue to price in a probability of a severe economic contraction, leading to a sharp drop in interest rates. So there's still very much that opportunity. Another is that the market expects that policy rates will naturally ease back as inflation softens, and supply and demand will return to a balance. That's the soft landing approach. And the meeting suggests there was an active debate about restarting the rate hike campaign. Now, I'm not entirely convinced that that's the case, but we've got other parts of the economy that don't necessarily suggest that would be the best thing for it. But we'll see here, because inflation, like they're talking about here, getting down to 3%, is going to be what they think quite quickly. But going from that 3% to 2%, like we've talked about for months on here, is going to be a much bigger issue. So I'll just give you guys a quote here. So it says here, while the governing council was more confident that inflation in Canada would continue to fall in the upcoming months to around 3%, the second stage of disinflation, all the way back to 2%, could prove more difficult. And this is because of 4 or 5 main points. Stronger than expected consumer spending. So that's still taking place. Higher global energy prices, which we're well aware of. Labor market tightness and rising wages. And the growth in government spending, Dan. Government spending, if you can believe it. With that being said, the debate around further rate hikes is actually, it's still there. And the Bank of Canada appears to be a considerable ways away from cutting rates. And this is because we're just not going back in many ways to that pandemic level emergency rate sort of scenario that a lot of people got accustomed to. So what are some of the economists saying about this monetary report? Well, the macroeconomist tone, and this is from Mr. Mendez with Desjardins, He said, "We still believe that there are enough cracks forming in both the economy and the financial system to keep them from raising rates further." And I guess the last part of what he's saying here is that while we continue to see the next move as a rate cut, it'll be around the turn of the year, a bit later than the market is currently pricing in, but still, that's much earlier than when the central bank seems to be saying. So it really sounds like, Dan, that there's this perspective from the bank where it's almost like a tactic to get you to not spend anything and to be reserved. But the whole idea of them, continuing the rate hike even higher based on what other people are seeing, I think the jury's still out on that one.
Well, of course, they keep telling us, or at least they have over the last year while they were increasing rates, that their number one mandate is to keep inflation between 2 and 3%. And then now they're getting close to that. They've got to kind of shift that tone and that sentiment into, I guess, the other part of what they do, which is to promote economic and financial welfare for Canada, which is a pretty complex statement, if you will. There's a lot of, obviously, items in that basket to make that stable. So with inflation being the loud part of their job over the last year and a half here, of course, that's been the focus. But again, with the June target still looking very possible for inflation to be sub 3%, they now have to look at the other financial woes that Canadians are experiencing right now, such as high interest payments on their mortgages, big interest on business loans. And it also seems that the Bank of Canada, or at least the markets rather, guessing as to which way the Bank of Canada is going to go next with their rates, it seems to change almost weekly. Last week's episode, markets were pricing the chance of rates dropping in 2023 by a quarter point as quite probable. And then now, of course, 1 week later, we're seeing the opposite happen and rates might increase in 2023.
In fact, Dan, I think even 5-year mortgage bond rates went up by 25 basis points on that comment alone, right? So, that tells you that the market is going, well, hold on a second. And we say that because the 5-year Canadian bonds are a great indicator of where 5-year fixed mortgage rates are going. So
exactly. And when we talk about these interest rates and where they're going and people's payments on their mortgages, inflation, part of the inflation basket is in fact mortgage interest. And interest costs are nearly up about 30% year over year. It's a huge number. And this is obviously understandable for all those carrying variable rate mortgages. That one component alone accounts for 0.8% of the percentage points of the headline CPI, which is currently at 4.3%. In other words, if we strip that out, because that part is almost caused by the high interest rates, the overnight rate by the BOC. So if we strip that out, the self-imposed high rates, actual CPI inflation is running at about 3.5% and would likely be sub 3 by just next month, being May. And that would be, or we're currently already, the lowest since around mid 2021. So interesting way to look at it. And it's somewhat odd that the mortgage interest is part of the basket, but we somewhat can understand why. But let's shift our tone a little bit here because we want to talk still about inventory, because inventory remains to be one of the biggest factors in what's driving the market and what's driving prices back upwards right now. We've shown this chart a couple of times, and if you remember, national inventory back as recent as 2015, national inventory sat at about 250,000 listings, 250,000 listings, and then that dropped dramatically, where it bottomed out about mid or early 2022 at 100,000 across Canada, an incredibly low number. And then thanks to when the interest rates started rising and people pulled back on buying houses, that inventory started to increase. And it peaked in this cycle, it looks like, at about 140,000 listings nationally. But that number is starting to drop again because, as we have been talking about for some time here, the listings are at multi-decade lows, new listings. But the fevered pitch of buying is back. And so we've actually seen inventory fall again nationally for 3 months in a row. And if you can believe it, Ontario alone dropped 9% in inventory last month. That's March. It's the spring market. We're supposed to see inventory. We typically see inventory increase March, April, May, June kind of thing. It's a very different market that we're in right now. And we seem to say that a lot because the markets have basically been unique since COVID. Wow, we've blown out of the cycles and now things just shift on what seems like a dime here. So very interesting times yet again. And we are seeing inventory at a time when it should be climbing, staying low, and new listings, again, multi-decade lows.
I'm gonna kind of do a little update on what's happening across Canada in a second here, and touch on that. But really, inventory remains to be an even bigger issue, if you will, than inflation is right now. I mean, we seem to have some sort of grasp on the direction of inflation in many ways, but we do not have a grasp on inventory. I mean, Dan, it was only back in 2015, 2016 where we saw, national inventory levels at 250,000, right? And now we're sitting less than or more than 100,000 off that number. It's crazy. It's never really recovered, which is kind of incredible. So to speak to that is the Canadian job market, which keeps blowing people's expectations way out. And I'll just touch on it briefly here, but unemployment levels still remain at record level lows. There's still 900,000 job vacancies, which is mind blowing. With so many people employed, Canadians also appear to be managing the costs and servicing their debts. There's still, as as many articles have read, there's still a lot of juice in Canadians' bank accounts. Credit card delinquencies are rising, but they are below pre-pandemic levels. So to give you some perspective, that was about 2% in 2020. We're at 1.5% today. So, the labor market still very strong, and rising wages are going to be a big part of that, getting inflation below the 3% threshold. But we'll see.
So that understandably makes the Bank of Canada's jobs a bit harder when we've got such a robust economy with home prices increasing. And again, over 900,000 job vacancies. It's been like that for a year. And yet we bring in so many foreign workers into the country, and that number is still almost at 1 million. And so this is going to continue to entice people from other countries to want to come to Canada. How could you not? If there are great jobs and great healthcare, great air, great water, everything that people come here for, and we've got a big sign that says, hey, come on in, we're open for business, people are going to do it. And that's going to be one of the major metrics I want to talk about next, because I've got 4 things I want to talk about that are really going to point to where we can expect prices to go next. It's kind of glaring here. It's kind of glaringly obvious even. First one is what I touched on a little bit earlier, is that the national new listings are at 20-year lows for 4 months in a row. And we're seeing that here in Vancouver as well. And this 20-year low in new listings is not adjusted for population. Okay, so we've put in, millions of people into this country over 20 years, and yet we're seeing new listings coming in at 20-year lows. So next, there's a metric that's calculated nationally. Here we go sales to new listings ratio, sales to active ratio, but nationally they actually calculate it sales to new listings ratio. And it's very much a leading indicator here. So much it reads out probably 3 to 6 months in advance. It's literally like having a crystal ball. And for those watching this on YouTube, I can put up the chart here. You can clearly see that when the sales to new listings ratio goes up, prices follow that. And when it goes down, prices follow that as well. So the ratio is up about 15% in just the last 6 months. And it is now in a seller's market across the country here. But prices, as you can see, or if you're listening here, they've basically just stabilized. They've kind of just hit what looks to be the bottom of this cycle nationally here. So expect prices to increase nationally and gain momentum based on this chart over the next 3 to 6 months. Okay, we just saw national prices tick up for the first time in March, and you're definitely going to hear that happen again in April, and by the looks of it, for at least the next 3 to 6 months here. At a time when we are very short on houses, housing starts, new homes being built are actually collapsing to the tune of like 11% just last month alone. And March being down 11%, it was actually the 4th month of the last 5 where we're seeing the amount of housing starts going down. It's the second lowest reading since about mid 2020. And this is, of course, happening because, again, it's very expensive to build, and it's a bit of a lagging indicator as well. Most developers don't build in a downward market because they can't hit their financing targets by pre-selling out 60% or so of a building. So now that people are back and trying to buy homes, so they got to start that back up again. And this is obviously an industry that doesn't turn on a dime. It takes months and months to get things started, to get your building permits, to get your team in place, etc. And now, a bit of a mind-blowing stat here in regards to population growth. In the first 2 months of 2023, new PRs, new permanent residents admitted into Canada, eclipsed 100,000. This is a record by a wide margin, and is technically, if it were to continue at that pace, we're on track for 600,000 PRs in 2023. On top of that, another record that has been smashed. Non-PRs hit 220,000 in the first 2 months of the year. Okay, that's your temporary foreign workers and your foreign students, for example, make up a big part of that. If that rate were to continue, it's on pace for 1.3 million non-PRs for the year. Add that with the PRs, that's 1.9 million into Canada, plus natural population growth. We're looking at what might be a 2 million person population growth in Canada in 2023.
Holy cow.
That's 5% growth. And this is that's almost double what we saw last year, which is a 50-year high record where we eclipsed 1 million. Now we're technically on pace here for about 2 million new people in the country this year. Phenomenal. So obviously those 4 metrics, I mean, come on, if you have no homes to choose from, new home building is way down. You've got 2 million new people coming into the country here. And you've got the sales to active listings ratio or sales to new listings ratio spiking, and prices just about to start catching up to that. All 4 of those things dramatically point to upward pressure in prices in the next 1 to 2 quarters here.
I just want to comment on some of those things because they're incredible. First of all, the housing starts that have collapsed by 11%. As you're hearing this, and then you're hearing, well, hold on a second, we have like an inventory crisis. Why aren't developers building? They should be able to sell everything. Much like you said, in a downward market, developers just go on hold. But, with the rise of 425 basis points, if you're holding on to 50 or 100 condos at that price, that's also why developers are not going to hold inventory right now, because it's way too expensive to do it. They will wait until interest rates drop, probably sometime next year, before they really start to pick up and start building again. The other thing that's mind-blowing here is the amount of people that are coming in, because if you look at the PRs that were admitted, that's 100,000. And then, like you said, Dan, there's 220,000 that are non-PRs that have come here. That's an indicator of the future buying market and the future rental market, right? And so if you're looking at the non-PRs, and we've already got record high rents, well, if we're bringing in more and more people to the tune of 1.3 million people, my goodness, rents will continue to go. And then the same exists for PRs who are available to buy said inventory. So I think there's significant headwinds for inventory in the future here as we're sort of delineating. I'll just touch on briefly a couple things too with respect to Canadian home prices. There were some notable regional differences in March, with sales surging 10% across BC in that month alone. The month prior to that was 7.3%. So some very strong sales numbers coming out of BC, generally speaking. When you look at Quebec and Ontario, they both saw sales that were up by 1%. And Alberta saw a slight decline, but they've been ripping while everything else has been down. So to give you some perspective, new listings, which were down across the nation by 5.8%, are now at levels last seen in 2004. Which is bananas. And the main point with this is that if we don't see an imminent reversal in these trends, we are going to see prices climb. Inventory will push that. As much as you want to restrict the flow of credit, the Bank of Canada will have the economy that it will break before I feel the inventory crisis here gets settled by interest rates. So, and to sum that up, so the first seasonally adjusted month price increase in a year happened last month. Leaves prices down 15.4%. From peak national levels and down 18% in Ontario. So we still have a considerable ways to go before we eclipse the previous highs.
And all these numbers and all these new sales and of course prices going up, it lends to a question that we get all the time from our clients and friends and colleagues. And they're always asking, like, who's buying? Like, we've got almost record high prices. We've got interest rates up 425 bips from when they were last or 2 years ago. Who can afford this and who's buying? And I kind of wanted to extrapolate a little bit on the question and I guess my answer, at least my thesis on who really is buying here, and just kind of shed a bit of perspective on it. Because people are right. I mean, the landscape we're in right now is full of bidding wars. We're seeing record prices again. We just set one ourselves in a building in Commercial Drive yesterday, and it's in an environment where basically the interest rates that drove down prices for 9 months are still here. It's not like prices or interest rates are dropping right now. So why are people back, and what's different? What's going on? Well, I think a big part of it is, of course, housing is vital to life. And what I mean by that is people that decide that they want to live in a home that they own, they're basically living in a home forever, right? It's either you're renting or you own, basically, or you're living with mom and dad. And for those that are owning, they're not looking at it, okay, well, here's the rate today, or this is what the bidding wars are like today. It's largely approached with a lifelong vision. Okay, I'm going to be a home owner for the next 40, 50, 60 years, whatever the case may be. When you look back, sure, people were buying at a bit of a frenzy 2 years ago when interest rates were a quarter point. But let's be honest, let's look back to the 80s when interest rates were 18%. People were buying houses then too. Yes, completely different scenario. I get it. But if we want to bring it right down to sort of one singular factor, being interest rates, because they're the biggest factor when it comes to buying homes, if people are okay or comfortable or can afford to buy at 18%, of course they can afford to buy at 4.5% as well. So let's go a little bit wider here and let's look at the numbers of what's happening just here in GVRD. So in GVRD this year, last year, we average about 3,000 home sales per month. Okay, that's 36,000 homes are sold a year here. The population of GVRD is around 2.5 million. So if you divide that down, you recognize that really about 1.5%, 1.5% of GVRD population buys a home each year. That is a very minor amount of obviously the amount of people living here. And the reality is a lot of what we see is people who are buying can afford it. And yes, there is a huge economic divide that is happening. And I feel that it is accentuating now. It's speeding up here, and it's not fair and it's not right, but it's the reality that we're facing. And so, yes, obviously, or understandably rather, the top 5, 10, 15% of the wealth of the people who are in that wealth bracket in GVRD can afford to buy, or they can help their kids afford to buy, and so forth. So when you look at, there's only this much, the top 5%, 10% of the entire population that can afford to buy, well, they are. And I think I almost relate it to what happened or what's happening, for example, up in Whistler. As many people may know, I grew up there in the late 80s and saw what happened up there with prices. And right now it's literally turned into like a playground for the ultra wealthy. When you've got your average home at $3 million up there, not too many people can afford it, but the demand to be there is on a global level. And it's a lot smaller. So we've seen it happen a lot quicker, but I feel we're seeing a similar thing happen in Vancouver, where more and more wealth is moving in here and they're pushing up the prices because they can afford to, and it's pushing out a lot of people who can't afford it. And it's not setting up for a very pretty future for a lot of people. And it's, like I said, it's not fair. It's not great, but I think it's the reality of what's happening is those who can afford to buy things are, and they're moving here in droves. And so, like we said, if we see 2 million people come into this country this year, and BC gets 15% of those, and 15% of those can afford to buy, well, they're going to. And it's a bit of a thesis. I might be right. I might be wrong. I'd love to hear your comments, but that's kind of what I'm feeling. And that's what we're seeing with our clients and colleagues' clients is The wealth that's moving in here is what's pushing up prices largely, and of course they are keeping it generational, meaning those people with wealth or who have seen huge appreciation within their real estate, they're sharing that with the next generation.
I think there's a
And
couple
then,
things that I just wanted to touch on there, Dan, just to your
yeah, please
points.
do, please do.
The first of all, the economic divide that you talk about is significant, because who are the people that are affected by interest rates the most? It's the people who can't afford it, right? So if you have, you know, millions of dollars in equity in your property, or you've got, even hundreds of thousands of dollars of equity in your property, you have options, right? And the people who are trying to get into this market now, if they can't get money that gets transferred through generational wealth, it's very difficult to buy in Vancouver, especially anything worth living in. The other thing that I kind of wanted to touch on, there's a little bit of a Charlie Munger theory, what you talked about at the start. For those who don't know who Charlie Munger is, he's Warren Buffett's right hand guy, and he's also 98 years old. But he brought up a really good point at their company's annual meeting, and he talked about Costco as an example, and he said, Costco stock at the height was $500, and it was crazy. And why would you buy Costco stock? And to his point, and kind of to your point, Dan, he said, well, if you're going to be in the market for the next 30 years, Costco's a great buy at $500. But if you're in the market for the next 2 or 3 years, it's probably something to avoid. And I think the same is here, right? Most homeowners plan to be in their home for 20, 30 years, especially that home that they can build a family in. So if they pay a lot now, it may seem like a lot until 20 or 30 years go by, and then all of a sudden it's been a great buy.
Yeah, it's exactly right. And I just kind of thought of an exact and very recent story that relates to exactly this example here. So we had a listing go up last week. Within 48 hours, we had 3 buyers come to the table. First buyer was a first-time home buyer, and they had to have subject to financing. Understandably, they were a little cautious, and they came in and they knew they were in a multiple offer scenario. So they came in at their best and final, as many do, and it was essentially right at asking price, because that was the absolute tip top of their budget. And we're talking about a $750,000 price point here. Offer 2 came in a little bit more aggressive. They were subject free because they had full confidence in it. They actually came in under the list price but felt that because it was subject free that they might be able to get it. And again, they felt that was the value of the property. Offer 3 came in all cash, literal cash, no financing, and over ask. And understandably, they got the home. Mm-hmm. So the wealth won in that case. And I know this happens time and time again. And so it makes it very hard, especially for, let's say, a first-time home buyer who has to have subject to financing or is cautious and is looking to buy at the top of their budget, where somebody who is wealthier, for lack of a better term, can just come in and steamroll that and just guarantee that they win. So there's an example. It's a
really good point. I mean, at the end of the day, we hear about it all the time here. There's a massive, not only just shift in generational wealth, but there's something to the tune of $300 billion of debt equity in Vancouver homes, right? So people who have lived in their homes for the last 20, 30 years, and their kids now are looking to buy, they can draw upon those massive gains that have taken place. And, $750,000 is a real number that can be taken out of a home that's appreciated by $2-3 million. So it's a real thing.
Yeah, absolutely. Okay, and then the last thing I want to touch on, because I want to put this on people's radars now, because I think it's very important. The Plex plan that we've talked about a bit, that you've likely heard of basically the blanket rezoning for all of British Columbia for single-family homes being allowed to build multifamily properties on that same single-family lot, will likely come into effect and will do so in early 2024. And if it does, I am firmly of the belief it will be the biggest private sector building boom this province has ever seen. There's going to be a lot of these foreign workers that are going to be able to come in and get a ton of jobs, for all the trades, electricians, plumbers, and so forth. But keep in mind, because of the demand for how many projects will likely go underway by mid or even early 2024. The ability to hire a tradesman or contractor will be virtually impossible. And you can also expect building supply costs to probably spike dramatically. So knowing that, if you're considering something like a renovation or a build or putting in a laneway, anything to that effect, think about it now. Hire your trades now. Get your building supplies now. Try to book out who you can now, because I honestly believe, like, we saw it happen in 2021, which was a very different world. But of course, everyone was doing home improvements then, and trying to get an electrician then. You were booking 4 to 6 months out, and you were paying record high prices. Well, I think that's going to be 10 times harder this time next year. So just something I wanted to put on people's radars. Think about doing your build now or hiring your trades now, because it's going to be incredibly hard once that Plex plan comes into effect.
The last thing I would add to that, Dan, is maybe plan for a longer permitting process. I hate to say it, but if the city of Vancouver, they're historically well known for taking forever to generate permits. I suspect that you may be waiting a little longer to get your permits as well. So the sooner you get started, now this plan still needs to go into effect, but I can't imagine them not pushing this through. I don't know how else they create density in the neighborhoods that need it. So, I think going forward, absolutely plan early and expect some delays.
Very true. Very true point. When you have 1,000 building permits submitted, in a weekend or whatever it's going to look like, it's you can expect backlog. So great point. Thanks everyone, as always, for watching, listening, tuning in. Forever fast moving market. So again, if you know someone who's going to benefit from the information we shared on this episode, please share the episode with them. Thanks as always. See you next week.